Hi everyone. Before I get to the topic of this video, I have a few things that I'd like to say. First, I'd like to say how humbled I was that several people decided to make donations on my website. I truly appreciate it. Not only will your support help me to pay for some indulgences like occasional family trips to national parks, but it also tells me that there are generous people out there who value the research that I'm doing and the reports that I'm putting out. I don't want to divulge names. Many of you are probably like me, and you like for your generosity to be expressed in private. In any event, you know who you are, and you should know how appreciative that I am. Now secondly, for those of you who didn't see my most recent video, please be aware that I have launched a free website where you can access my research in written form. I truly believe that written articles are better suited for my work, though I will still try to put out summary videos for each one of these reports, and that's what this video is intended to be. If you want to read the articles, please visit evidencebasedwealth.com. There will be a link in the description. You can also set up an RSS feed so that you will always be notified when I post something new. Instructions for how to do so were in my last video. Now, I'm going to work on putting together an email mailing list for those who would like to be notified by email. But given that web design is not a strength of mine, at least not yet, it might be a week or two before that functionality is available. Now, speaking of those who didn't see my most recent video, I've been informed, as I suspected, that subscribers who have been with me for a long time are no longer receiving notifications when I post a video. I was afraid of that. Yet another good reason to launch an independent website. Anyway, if you are not receiving notifications, please take a moment to click on the notification bell below this video. Please also take a minute to give this video a thumbs up so that YouTube is more likely to put it in front of people. Commenting also seems to help. Okay, now with that all said, let's get on with the video. This is just a high-level summary of my article, so those of you who want to delve into this in more detail, please go to my website. I haven't talked about this much, but many years ago I owned a few duplexes in my neighborhood. Their value didn't plummet in 2008 and 2009 like houses in major metropolitan areas did, most likely because they also didn't participate in the tremendous run-up in prices seen in major metropolitan areas in the mid-2000s real estate bubble. They just served their purpose, providing healthy cash flow. Now, I bring this up because when most people talk about the real estate market, they either focus on what they've heard in the news or otherwise focus on their local area. Prices can behave quite differently in one geography versus another. It's a similar story in the stock market. When we refer to the S&P 500, we usually don't think about the fact that 25% of it is just 6 large stocks, and that they are all technology companies. Much of the movement of the S&P 500 lately is just the result of speculative activity in these 6 stocks. The performance of smaller companies might be quite different. The performance of value plays, non-technology companies, small companies, and international companies might and probably will be quite different. Now, what you see in front of you is a chart of the Wilshire U.S. Large Company Growth Index divided by the Wilshire U.S. Large Company Value Index. These Wilshire indices are total return indices, so they reflect the impact of reinvested dividends. Now, I don't know how many of you remember the tech stock bubble of the late 1990s, but I sure do. It was an interesting time of companies without revenue and nothing but sock puppet mascots buying multi-million-dollar commercial spots on the Super Bowl. It was a time when experts were making up new metrics such as eyeballs to juice up stock prices. It was a time when lots of us were told that we were dinosaurs and just didn't get the new economy. When the bubble popped, the S&P 500 stock index declined by 48% over the next 2 years. But not all stocks lost the same amount. Growth stocks, the ones that comprise the large amount of the S&P 500 due to its market capitalization weighting structure, lost 63% on average, while value stocks lost 29%. It took 13 years for growth stocks to break even, assuming the investor held a diversified basket of them and wasn't wiped out completely because of speculation in a few small names. Value stocks, by contrast, only took 2 years to break even. From 2000 to 2005, value stocks outperformed growth by more than 100%. So just like in real estate, it does matter where you buy. Location, location, location. Now, given the parabolic shape of this curve leading into the year 2000, nobody should have been too surprised about that a crash was coming. but it was a crash that was largely avoided by those who bought the value indices. The same cannot be said for the 2008-2009 financial crisis, when value stocks lost more, but more on that in the article. Now, are we in a similar situation to the one that we were in during the late 1990s? I think we're getting pretty close. Look at the eerie similarities. We have a very heavy concentration of just a few tech names in the total market index. The price-to-earnings ratio on growth stocks is in the neighborhood of 40. The price-to-earnings ratio on value stocks is closer to 17. That means investors in growth stocks are willing to pay more than twice as much for every dollar of earnings in growth stocks. The Wilshire Growth Stock Index outperformance has reached levels that we haven't seen since the late 1990s. Will it be different this time? Perhaps, but that's not my bet. Now, if you'd like to know more, please visit my website, evidencebasedwealth.com, and please don't forget to hit the notification bell and the like button. It's a shame YouTube shadow banned me, but at least now there's a website available so that I can keep bringing you this material. Thanks for your attention.